Welcome to The Explainer. Today, we're looking at a company that is, well, it's almost certainly in your bathroom cabinet right now, Colgate-Palmolive. It's a household name for sure. But the real question is, should it be in your investment portfolio? Let's find out.
So, we're going to break down Colgate's entire business, but we're going to do it from an investor's point of view. We'll look at the good, the bad, and of course, the bottom line.
Here's how we'll tackle it. First, we'll look at the company's strengths, its fortress of brands. Then we'll check for any cracks in the armor, the key risks. After that, we'll explore where their future growth is going to come from, and we'll wrap it all up with the investor's bottom line, the numbers that really matter. All right, first up, let's really dig into what makes Colgate-Palmolive such an enduring and powerful business. Okay, so if you're an investor, one of the first things you're looking for is something called an economic moat. It sounds fancy, but the idea is simple. Think of a castle. The moat is what protects it from invaders. For a company, it's the competitive advantage that protects it from rivals. So, what's Colgate's moat? Well, it starts with this number right here, 41.6%. That is Colgate's share of the entire global toothpaste market. Just think about that for a second. Out of every 10 tubes of toothpaste sold anywhere in the world, more than 4 of them are Colgate. That kind of dominance is just incredible. And you can see here, the oral care division is the absolute heart of the company. It's driving 43% of all sales. Now, don't get me wrong, pet food and soap are important, but at the end of the day, Colgate's fortune really rises and falls with toothpaste. And that's both its greatest strength and, as we'll see, a potential weakness. So, to sum up their strengths, you've got these powerhouse brands, a distribution network that is truly massive, and a really strong position in the fast-growing pet nutrition market. These are the pillars holding up that economic moat. But no fortress is impenetrable. So now, let's go looking for some cracks in Colgate's armor and really understand the key risks that investors need to be watching. And this is a big one. The company's greatest strength, its dominance in oral care, is also a huge risk. They're so reliant on that one category. If you compare them to a more diversified company like Procter & Gamble, whose biggest segment is only 36% of sales, you can see how a big disruption in the toothpaste market would hit Colgate way harder. Now, being a global giant has its downsides, and this is a perfect example. On the ground in Latin America, business was booming, up over 14%. That's amazing. But on the official reports, it actually showed up as a loss of 3.2%, all because of a strong US dollar. For an investor, that kind of thing creates a ton of unpredictability. And then there's this kind of concentration risk, 11%. Over a tenth of Colgate's entire revenue comes from just one customer, Walmart. Now, that gives Walmart a massive amount of power when it comes to negotiating prices, and it means any little change in that single relationship could have a huge impact.
So, to put a bow on it, the big risks you gotta watch are this deep reliance on oral care, the headaches from foreign currency, that customer concentration with Walmart, and of course, the ever-present threat from cheaper store brands.
Okay, so we've sized up the risks. Now let's turn to the other side of the coin. How is Colgate actually planning to grow? So where's the growth coming from? Well, the chart makes it pretty clear. It's all about emerging markets. I mean, look at North America, growing at a slow and steady 2.5%. But then you look at Latin America and Africa. They're just exploding with growth. That is a massive runway for them to sell more products. The second big growth engine is their pet food business, Hill's. It's actually growing faster than the rest of the company, and it's all because of this pet humanization trend. We treat our pets more and more like family, and we're willing to spend a lot of money on high-quality food. Hill's is perfectly positioned to catch that wave. And finally, they're really disciplined with their acquisitions. They're not making huge, risky bets. Instead, they're buying these smaller brands in attractive new areas like professional skincare or fresh pet food. It's a really smart way to add growth without rocking the boat. So, how does all of this, the good and the bad, actually translate into financial performance? Let's get to the bottom line for shareholders. Now, this number, 33.9%, this might be the most important one we look at today. It's their return on invested capital. And simply put, it means for every single dollar Colgate invests back into its business, it generates almost 34 cents in profit. That is a sign of a wildly efficient company, and it just blows its rivals out of the water. And when it comes to rewarding shareholders directly, Colgate is an absolute legend. 62. That's 62 consecutive years that they've increased their dividend payment. That puts them in a super elite club of companies called Dividend Kings. For income investors, that's pretty much the gold standard. And this isn't some recent thing either. They've been paying dividends since 1895. This just shows you that returning cash to shareholders is baked right into the company's DNA. It's a core part of how they operate. But of course, you can't evaluate a company in a vacuum. To really understand its value, we have to see how it stacks up against the competition. When you lay all the numbers out side by side, one thing just jumps off the page: that gross margin. At almost 60%, it's just head and shoulders above its competitors. That's the financial proof of their powerful brands. On the flip side, you can see their growth is solid, but it's not exactly spectacular compared to some of the others. So what's the big takeaway here? With Colgate, you're buying a best-in-class, highly profitable business with a rock-solid dividend, but you're paying a fair price for it. It's a premium company, but it's not selling at a discount, and you probably shouldn't expect explosive growth. And that brings us right back to our original question. Colgate gives you that defensive stability, incredible profitability, and a dividend you can count on. The trade-off? That heavy reliance on one category and more modest growth. Is that the right balance for your portfolio? Well, that's the question every investor has to answer for themselves.